this race of accumulating metals and other commodities even is just at the beginning in my view. And I think we're going to see prices of metals that are likely to surprise everyone, not even myself. No, I'm as bullish as you could be. And I think I would be surprised at the end of this era. And I'm probably going to be the one selling it early. We were about to see a commodity bull market, and that tangible assets, particularly commodities, would benefit tremendously. After seeing all this and starting to unfold, we've been in sort of a rotational dynamic for commodities, of which there's always the flavor of the month, and that tends to see or experience a large surge in prices that is then shifted towards a second commodity.
The commodity bull market is just beginning, with metal prices expected to rise significantly, potentially beyond even the most bullish predictions. The market has been experiencing a rotational dynamic, where different commodities take turns surging in price before the momentum shifts to another. Tangible assets, especially commodities, are set to benefit tremendously from this trend. The speaker, Tavi Costa, a global macro investor and portfolio manager at Crescat Capital, highlights the ongoing accumulation of metals, particularly silver, zinc, and lead, with Chinese buyers paying premiums to secure supplies. This trend extends to gold, where central banks have been discreetly amassing reserves at a scale that cannot be explained by typical market activity. The rise of cryptocurrencies, especially Bitcoin, is seen as a potential distraction from the historical role of gold as an actual store of value. The speaker questions the origins of Bitcoin and suggests that behind-the-scenes negotiations regarding gold are more significant than widely recognized. Additionally, the U.S. may be on the brink of significant policy shifts concerning gold, with figures like Treasury Secretary Scott Batson, who previously held significant gold investments, playing a key role. The speaker emphasizes that gold remains the ultimate hedge against financial instability, serving as an anchor amid mounting leverage in global economies. While other commodities will perform well, gold's historic reputation as a haven and stabilizer of monetary systems remains crucial, especially as the U.S. and other nations navigate economic uncertainty. Let's dive into the video for more insights. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
Yeah, I probably one of the things that have been happening, look, I spoke more directly about silver because I've been involved with that. I've also been involved with zinc and lead, that we've experienced similar transactions where, for instance, Chinese parties paying, significantly more than market prices to secure metals. But this is clearly happening in the gold space as well. Gold, it's almost funny to me to see this euphoria towards crypto, and it makes me wonder who created this whole space and who really initiated Bitcoin and all that, given the fact that we don't know who did it. Because it's almost like a perfect way to distract the Western societies from the bigger picture of really owning a hard asset like gold in order to protect its monetary system. And so there are a lot of big negotiations happening, that are under the table, or I should say off the radar. It's a better term, that I don't think people are necessarily fully paying attention to. One of them that I'm referring to is what central banks have been doing in terms of accumulation of gold. When you look at the price of gold itself, it's hard to justify this move we had over the last year and a half by just calculating it by looking at Western investors and others that have been reported as buyers pushing up the price, because that is not in line with the type of movement we tend to see in terms of volume. And so there has been a lot of buying that is, as you mentioned, outside of the what's been calculated when it comes to indices and other exchanges that tend to track those things. And that's quite concerning. And I would say, I'm paying close attention to what the U.S. is about to do, because I do know Trump is a big fan of gold and he's playing this Bitcoin game. But one thing I learned in my life is that when you do want to buy a significant amount of a certain commodity or a certain asset, what you don't do is announce to the whole world that you're going to do it, right? You buy it and then you tell the world, this is what I've just done. And I find it interesting, the fact that people are looking at this whole story about And again, it's nothing against Bitcoin. I just think it's missing the big picture here of what gold really is, what gold really means to this whole setting of, really historical levels of leverage that almost forces economies to accumulate the metal to enhance the quality of their international reserves. And I do think that the U.S. is getting close to some radical changes in its policies in order to do that. Their openness to talk about Bitcoin, imagine what is happening closed doors when it comes to gold. Scott Batson, the Treasury Secretary, if people don't know, and again, a lot of people don't like to talk about him just because he worked for Soros, but pay attention to what he's doing. His largest position right before taking this job was gold. Wasn't Bitcoin, wasn't oil, wasn't silver, was gold. That doesn't mean other commodities and other things shouldn't do well. All I'm saying is clearly there's a understanding of the history and the credibility and also the reputation of the metal of being able to act not only as a safe haven, but truly as an anchor to a falling monetary system like the US dollar and other fiat currencies.
In a recent interview at Liberty and Finance, the speaker, Tavi Costa, describes a shift in perspective on commodities around 2018 and 2019, driven by declining capital investment in resource production. This led to a bullish outlook on commodity prices, though initially it was unclear which specific assets would benefit most. Given the long supply cycles of 10 to 15 years, the focus turned to mining, reinforcing confidence in tangible assets. A commodity bull market began unfolding with a rotational dynamic where different commodities took turns experiencing price surges. However, a more concerning economic realization emerged. The U.S. was allocating 4 to 5% of its GDP solely to service its debt, a level far exceeding other developed nations, including Japan, which spends less than 1%. Tavi Costa explains that, historically, financial crises and currency devaluations have been driven by debt levels and the rising burden of interest expenses relative to GDP. The U.S. is approaching a tipping point where it may be forced to cut interest rates, not because of falling inflation but due to unsustainable debt costs. This scenario suggests an inevitable devaluation of the U.S. dollar rather than strengthening it. The speaker argues that as economic pressures mount, the government will have no choice but to suppress interest rates, ultimately weakening the dollar against other fiat currencies. Now let's shift our attention towards the interview.
Yeah, I think, back in 2018, 2019, we've had a big changing views of our commodities, mostly coming from what was happening in terms of the producers and the capital spending in this whole industry of resource industry overall. That kind of shifted to being very bullish on resource prices. We just didn't know which commodity we should be expressing that view. That then led us to mining because of the duration of this industry that tends to take about 10 to 15 years to see new supply, which also, and I'm just sort of kind of explaining how we got into tangible assets that, just gave us very high conviction that ultimately we were about to see a commodity bull market and that tangible assets, particularly commodities, would benefit tremendously. After seeing all this and starting to unfold, we've been in sort of a rotational dynamic for commodities, of which there's always the flavor of the month, and that tends to see or experience a large surge in prices that is then shifted towards a second commodity or another commodity later on. But what is more interesting is that the later stages of this evolving research is that when I learned that the U.S. was spending about 4 to 5% of its GDP just to pay down taxes or to service the debt, I think this is well known by most the community of investors, but what they tend to dismiss is the fact that there's not a single economy in the world that is large like the U.S. or developed as the U.S. That is currently paying anywhere close to those amounts. Even countries like Japan that are highly levered are only paying less than 1% of their GDP when it comes to the amount to service their debt. And, learning from the UK era in the 1800s, one thing was clear. It wasn't necessarily, and a lot of people, again, dismiss this fact. It wasn't necessarily the amount of debt relative to GDP that led to the destruction of their monetary system at the time and the change of the global reserve currency status of the time as well. What really led to that was the issue with this growing pressure of the interest expense relative to GDP. And ultimately, that is essentially what causes countries to restructure their debt or get to a moment where they're just forced to suppress interest rates in order to survive. And so I think we're getting to that point. I think a 4 to 5% of GDP level is something we have never seen actually in a very long time. And I would suspect that we're getting very close to a very significant cut of interest rates in the US that is not justified by inflation falling, that is actually just justified by the fact that the government is broke. And ultimately, that is what drives the US dollar lower, not higher. And there's more to this, but that's essentially, this is the gist of the whole, the essence of this thesis that the dollar is, very overvalued relative to other fiat currencies as well.
The ongoing commodity bull market, rising central bank gold accumulation, and mounting U.S. debt concerns point to significant shifts in global financial dynamics. While commodities, especially gold, continue to serve as vital hedges against economic instability, the U.S. may soon face drastic monetary policy changes to address its growing debt burden, potentially leading to a weaker dollar. How might a weaker U.S. dollar impact global commodity prices and trade? What role could central banks play in shaping the future of gold as a monetary asset? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.